Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back and kick up your feet because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Hello, Lower Alabama. Hello, Gulf Coast. Welcome in. Welcome to Coasting in Retirement. Thanks for joining us today. Josh Knoll here. I've got a very special guest today, Mr. Sam Driver. He is CPA and partner with a fully based accounting firm, Johnson, Slaughter, Driver, and Northcutt. Sam, how you doing?
Pretty good, Josh. Appreciate you having me.
Oh, come on, louder. Are you nervous?
No, I'm not nervous.
Oh, good. All right.
We're good.
First time on the radio, though.
This is it. First time.
You're going to have people texting you saying, hey, is that you on the radio?
Well, I hope so.
Yeah, we both hope so. Well, Sam and I are here in Coastal College's recording studio, beautiful downtown Fairhope, ready to put on a great show for those of you tuning in. Listeners, we are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we've got in store. First segment, deep dive on our topic of the day. Second segment, about 30 minutes past the hour. That's headlines of the week. And then roughly 50 minutes past the hour, stick around for our third segment. We call it Joshua's Crystal Ball and Big Mouth. I want you all to buckle up. We got a lot to get to. Quick background on me, for those of you new to the show. Again, my name is Josh Knoll. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That is a 100% locally owned, 100% independent investment management and financial planning firm. We have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and the team at Gulf Coast Financial Advisors by visiting our website. That's gulfcoastfa.com, or feel free to give us a call anytime, 251-327-2124. Now, if you just missed that contact info, grab a pen and pad. We're going to repeat it several times throughout the show. So, Sam, before we get into our main topic, would you mind to tell the listeners a little bit about yourself?
Yeah, sure. No problem. Born and raised in Baldwin County here. Went to Coastal Alabama for a couple years, then went to University of Mobile. It was called Faulkner back in the day.
Was it?
Coastal Alabama. But,
okay, that's right. They bought them out, right?
Yeah, well, they changed the name. But University of Mobile, played some baseball there as well. Got my accounting degree. Married my high school sweetheart. Got 2 children. Got one in University of Mobile at the moment. He's graduated with an accounting degree, going
nice.
for his 5th year, and I got a daughter that's a junior at Auburn. So,
War Eagle.
Yeah, that's right. That's right. Have to admit we're Tide fans, but I do put on a shirt a couple times a year.
Oh, you do?
Yeah, I do.
Okay.
So got into the accounting space and been a partner and involved with the firm I'm at now, Johnson, Slaughter, Driver, Northcutt, with I guess going on 20 years at the moment. So. We do, mainly a tax-based firm, advisory firm there. Do a lot of small business type work with a lot of individuals, different times of their life during the business sector. So that's a little bit about where I'm at and who we are.
Very good. Yeah. So we're going to dive more into that as we get through the show. But let's get to our main topic. So, listeners, you can imagine, first time. Now, I told them about 3 or 4 weeks ago I was having a CPA on, so the regular listeners know you were coming. They didn't know when. But with an experienced CPA as a guest, we're going to be talking about taxes. Sam, we focus this show on folks that are in or near retirement, especially you business owners that are listening. So what I did is I asked Sam to come up with 3 tax topics that seem to be top of mind for mature business owners. And so what I'm going to do, I'm going to list those 3 topics, and then we're going to discuss each in more detail. And I do want to do a quick disclaimer. Sam, you know my business well enough to know I got to, disclaim that I know anything. Basically, you say something really smart, and then you tell somebody to completely ignore what you just said. But disclaimer, there is no way, listeners, for Sam or me to know your specific tax situation unless we talk to you. So please don't take anything we're about to say as any individualized tax advice. That said, my guess is that many of you are going to be curious about these tax topics and the headlines that Sam and I are going to talk about. And, Lord knows, like on this depreciation thing we're about to talk about with my dad, he'll be hopefully listening in. So let's get to the 3 things. Number 1 that we're going to talk about today is the depreciation deduction under current tax law. That's number 1. Number 2 is business retirement planning, which, I extrapolate that as tax planning. And then number 3 is corporate entity structure or formation. So let's do this, Sam. Let's get to our first item on the list. What is depreciation, and why is it so important to business owners, or to really anybody self-employed, I would imagine?
Yeah.
Okay.
Yeah. So kind of business owners is a kind of broad topic. It can obviously be an individual doing something, or somebody that is structured up to the T in a corporation level with millions of dollars of revenue. So it all kind of works the same. Some numbers are just bigger than others. So basically, depreciation is the deductibility of an asset that was purchased, some tangible property that they bought either to do their work, or a vehicle to ride around in, or the chair or desk that we're sitting in right now.
Mm-hmm.
So basically, it's the rules and regulations on how do we recoup that investment in the business. And there's a couple different ways to do that. One, there's always been depreciation. You do it over a life cycle of the asset. The IRS kind of predetermines that life cycle. It's either 3, 5, 7 years. It can be 15 or 20, depending on what type of asset it is. And you write that off over that period of time. Or there's what they call Section 179, which you can deduct 100% of that. There's limitations and certain criteria there that you got to meet. And then back in 2018, when they first kind of changed the tax law under the Trump administration.
Mm-hmm.
They come up with 100% deductibility we'll call bonus depreciation.
Okay.
All right, that sunsetted or was sunsetting through the years, the last 3 or 4 years. It was 100%, and it went to 80, and went to 60, 70, and before the change on July 4th, we were down to, if I bought that $100,000 piece of equipment, I could had an option there under bonus depreciation to deduct 40% of that. Well, that law changed. Now we're looking at the 100% deduction again, which is, very advantageous for a business owner. Now, we have that option, and you can make these elections or the criteria that we use to determine what's better or worse, on a year-by-year basis. So basically, coming into this year, we have some options on deducting those assets, and that's where it lies at this point.
So with, you were saying, I'm looking at the phase-out schedule. Mm-hmm. It was 40% for 2025 that you mentioned. So for educate me, does that mean that we are immediately popping back to 100% depreciation on the bonus schedule?
Yeah.
Okay.
So basically, if you purchase that asset, and don't quote me on this date, but if you purchase it after January 12th, I believe,
okay,
or somewhere around, if you bought it first week of January, you're kind of in... You bought it too early,
right.
But if you bought it after that, you have an option there to deduct it at 100% versus that 40% rate.
And when you are looking at what's the best choice for someone to depreciate all of it now or spread it over time, you're balancing that out with maybe, is this a high revenue year? What's kind of some of the factors that go into that decision?
Yeah, so the main emphasis we're looking at is revenue, of course, because that's going to drive our tax liability. But, when we get to the industry structure here in a little bit, a lot of other things kind of play into that role. You may have multiple businesses. You may have 3 or 4 kids, or, they're under a certain age where you get some credit. So it's not, I made some money, so let's deduct everything. But that usually is the first initiator of our discussion, at least. That's the first topic, because we are trying to minimize that. And then the whole purpose of this accelerated depreciation option is to invest in your company. And when we invest, obviously there's a trickle-down effect there on who's it helping in the economy. So there's an incentive there to buy that piece of equipment or asset to where I can, recoup some of that tax burden now versus having to write it off over a certain amount of time. So it maybe it gets me into gear wanting to put some money in my company versus not in that particular year. But yeah, revenue would be the first, or net income would be the first indicator on, hey, what do we need to do right here?
Right. And I'm looking at this chart. Tell me if this was accurate. Mm-hmm. But obviously land, you can't depreciate land.
That's
right. You can depreciate residential rental property. Is that accurate?
That is accurate.
Yeah, over a long period of time, you can depreciate commercial buildings. Mm-hmm. There's something called a cost segregation study. Does that ring a bell with you? Is that something that you all look at?
Yeah, we do look at that now, especially with this accelerated depreciation factor. Now, there's other things that we got to look at. So anything 20 years or less in a life, in the predetermined, where it fits in the IRS schedule, is qualifies to be deductible at that 100% rate. Residential rental property is a 27.5-year asset.
Okay.
Commercial property is a 39-year asset. So blanket covers, those would not qualify. Now, when we do a cost seg study, or we have a cost seg study done on that residential rental condo or that commercial building, this engineer study will break down that cost structure into different life cycles. They'll have some 5-year assets, they'll have some 7-year assets, it'll go on up. Majority of that purchase price is going to be in that longer term asset, but if we free up, $200,000 on $1 million purchase,
that's a huge cost savings.
That's a big deal. Now, you got to look further down because there's some passive activity losses and rules you got to follow. And I don't want to get in the weeds on this right now, but
it's not something you just do just blindly and quickly. There's some thought in it.
Yeah, and unfortunately, there's a lot of information out there that people do jump into that without actually looking at the details.
It's like the Roth conversion in our world.
Oh,
you got one-trick ponies out there that tells everybody they should do a Roth conversion.
That's right.
And then they get in it. They get some headaches.
The worst thing I can do, you have that conversation with the client that's already done this and spent the couple $1,000s we're doing, which makes sense, and then you come back and say they can't deduct it.
Right.
You don't lose it by no means, but you're able to write off that asset over a 5-year period versus doing it all now, and so it does make sense, but maybe they didn't get the whole scenario.
Well, regular co-host Michelle is listening, and I know what she's thinking. She's thinking, as a 1099 employee, as a radio show host, if she wants a Porsche Boxster, so she's going to want to know, is that Porsche Boxster going to be fully depreciable in her current situation? I'm being funny here.
Yeah, well, I mean that's actually a good, maybe not the Porsche example, but vehicles for sure are a big topic for business owners because one, they got to have it, but there does have to be a business use. It does have to be 100% business use or more than 50% in order to kind of take advantage of these things. So you do definitely want to kind of talk over these items with your counsel before you kind of move forward and think you're getting something before you don't.
Right. All right. Very good. Well, let's pivot on to number 2. What is tax planning for business owners? How does this work? Business retirement and tax planning. So, Sam, in your line of work, is there a difference between a tax preparer and a tax planner? Correct?
Yeah, definitely. Typically, you should be able to do all of the above, but, I'm not throwing anybody or labeling anybody, but if somebody's just taking your information and doing tax returns and they're not planning a lot, usually the planning is done prior to the year ending and during the year and that kind of thing.
Right.
And we got clients all over the board on that as well. We have clients that we talk to regularly.
Right.
Right now, we're in the planning phase. Year end's coming up on a lot of these calendar year taxpayers. So we're in this planning mode at this point, but planning starts on day one. It's hard to be reactive instead of being, looking ahead, trying to make sure we're proactive.
Yeah, because I'm assuming tax planning, tax advisory can have a huge impact on a business owner's bottom line, right?
Sure, definitely.
Right. Yeah, in our line of work, I would say the somewhat apples to apples comparison would be there are advisors and brokers that only do investment management, and there's nothing wrong with that. It's always going to be kind of in the moment what's going on. And then the majority, or at least a lot of us, have pivoted to more comprehensive financial planning, where we're trying to stay a step ahead of these things, right?
Same scenario, yes.
Yeah,
sir.
Same scenario. So when you are having these, when we're having these conversations with business owners, self-employed people, most people that, so let's take the clients that I've referred to. We've got clients that have more often than not taken some type of risk or some type of chance to get this business off the ground. A lot of times they didn't make a ton of money in the beginning of the business. I'm a prime example of that. It took a while to get Gulf Coast off the ground. And now they've reached a kind of a tipping point, or they've already passed the tipping point where they've got significant revenue, which is great. It's enjoyable. But as a result, they got significant taxes. And a lot of times they have not adjusted their tax planning around this significantly larger amount of revenue. Let's walk through a little bit of that conversation because they want to look at, hey, what's the difference, Sam, between tax avoidance, tax deductions, tax deferral, what line are we trying to get to there?
Yeah, so we try to stay away from the tax avoidance area.
Right, that's the bad side of it.
Not something we want to play with. But,
right.
In a tax code, there's a lot of gray area items, and as long as we're being proactive and doing things under the regs, then you shouldn't have any issues. And back to what you were kind of trying to explain, we deal with clients all over the board, new clients to startups to 20-year guys that have been in it for a while. And those needs kind of change throughout the year. So of course, we're not going to lay out the green carpet and try to, retirement plan when we got somebody 2 to 3 years inside the business and trying to make it work. There's areas there that we can start planning. Here's what we want to do with this. You're making this. You kind of see some growth. What's the next step? Well, we need to put some money away. And there may be a client where we've, they've been in the mud, 20 years to it and have some money saved up, or may not,
Right.
And now what do we do? So it's really dependent upon what that client is, but obviously we want to have those conversations early in regards to, getting people like yourself involved to try to educate them and understand that, we can't do this forever, so we got to plan on that.
Well, because more often than not, the business is the owner's largest asset.
That's
is that
right.
pretty typical?
That's their investment.
That's their investment. Yeah. And, to be fair, a good investment management or financial planner should make you a competitive rate of return, but more often than not, it's going to pale in comparison to the rate of return you had on investing in your own business.
Sure.
Right? I mean, some of our more successful business owners that you've seen, Sam, they started this thing on bootstraps, right? And now it's worth millions of dollars.
That's right.
It's really cool to see.
It is.
Yeah, especially you do quite a bit of planning around, and when obviously we're working on some current situations around folks that are that situation they're trying to sell the business.
Mm-hmm.
So tax planning is pretty important with that on selling the business to the next generation or third party seller, right?
Oh, definitely.
Yeah. All right, very good. Okay, so now the third item is setting up the corporate entity. It's the last thing on our list. We touched on it a little bit, but corporate entity structure. So, personal experience. As someone that has I've paid self-employment taxes years in the past. It aggravates me to no end, but there were situations when I got in the business early, 1099, there really wasn't a way for me to do an S Corp or anything like that.
Mm-hmm.
So I can personally vouch for the importance of having a corporate entity and getting to that point where you can have that structure and having the appropriate one for a situation. So, Sam, do you have a go-to corporate structure for your small business owner clients? Walk us through when you've got somebody. Let's use my situation as an example. I coming up way earlier in my career, but I was 1099 coming up, and then I built a business, and now I'm making that switch. What am I looking at from a corporate structure standpoint?
Yeah, so we get that question a lot. We deal with a couple different structure entities, and we'll talk about the service sector in a sense here. If you're getting 1099 income and are just, beating the bushes and doing things on your own, we definitely want to at least start with an LLC setup. That'll give us some options down the road. You can also form a corporation and elect an S Corp status at that point. But at least that gives us an option and also gives you some, and I don't want to get into the attorney side of things here, but gives you some liability protection as well.
Sure.
Versus just operating as yourself. So just to be clear, the deductions I can deduct from a sole proprietor, a non-entity based business, are the same as an entity based business.
Most people don't realize that.
They don't realize
you
that.
do that on sole proprietor, you do it on a Schedule C, correct?
Yeah, that's right. That's right. And you get the same deductions that are allowed here versus there. May be a little bit of a differences on certain things you can do from a retirement standpoint and what you can implement. But all in all, a supply expense is a supply expense regardless of what type of entity you're in. So at least having that LLC structure at the very least will give you some options down the road. Now that doesn't change, and I'm talking, there's a difference between a solo member and a multi-member LLC.
Right.
But all in all, from a service-based sector, that income subject to SE tax, self-employment tax.
Okay.
So at least having that structure gives you the ability to convert that to a partnership or a sole proprietor or a single member LLC into an F Corp status, to where we have some options there to defer some self-employment tax calculations. Now, we can't get rid of it because there's certain criteria we got to meet and follow, reasonable comp scenarios in that S Corp. I don't want to get in the weeds there. But
well, you can't just do S Corp for a hobby that's right. Is losing money or, right?
That's right.
Yeah,
There's really no need for that. So
basically,
basically,
got to pass the smell test.
Just to put some numbers on paper, $100,000 net income, taxable income, sole proprietor or single member LLC is going to generate about $15,000 in SE tax.
Either way,
doesn't matter. And then you're going to have, regular taxes on top of that. So what we do certain scenarios there is we take that LLC and we convert it, make a tax election to be an S corp, and at that point, S corp income is not subject to that SC tax. Well, that sounds like a great tax planning move, but it's not. That's not all there's to it. Under that S corp, we got to pay a reasonable salary. That reasonable salary that's where you're going to pay that Social Security, Medicare side of things, that 15%. And again, we can't lowball that number. It's got to be reasonable. That's the key.
Right.
There's no criteria there where the IRS kind of puts out there, here's what it has to be in an HVAC company, here's what it has to be under a financial advisor company. So we got to use some tools that we have to come up with a reasonable comp. But if we're able to save the client, $5,000 that particular year,
with basically paperwork, appropriate paperwork,
and planning. You can't do this after the fact a lot of times.
Right.
So it's just being proactive, being during the planning phase and structuring that business correctly can save definitely thousands of dollars over a period of time. If you take that $5,000 over a 5-year period, that's $25,000. That's real money,
100%.
So, and we try to educate our clients and at least see that big picture there, because they may not think it's worth the hassle,
right?
To do that. I'd rather just pay $5,000 and go on. I got to worry about salary, that kind of stuff. Well, look at it collectively over a period of time. One, you're putting yourself in a position for liability purposes, is going to be a game changer,
right?
But also, if we're able to save. If the taxpayer is able to save some significant,
especially if
you
for businesses where the revenue has gotten pretty large, where they've got a way to incorporate that reasonable salary and yet still have a lot of upside headroom there.
Sure,
right?
Definitely.
Now, what happens with the profitable business owner that has a reasonable salary that covers their, that would pass the smell test, covering their personal expenses, has revenue, has enough significant profit that they don't necessarily want to pass that profit through? What does that business owner do in that situation? Can they retain it?
Yeah, you can retain it. You can invest in the company. You can implement retirement plan strategies, that kind of thing.
You can buy a Porsche Boxster and depreciate it immediately?
If it's business related, we can talk about it. Sure. That's where all the things we talked about prior to this little segment comes into play. Do we need that bucket truck or that, different scenarios there that we can, keep that money inside the business,
right,
or put it on a shelf for you later.
Well, everybody, you hear the joke. You don't strike me as somebody that says, well, hey, just go buy an F-350 real quick before the end of the year and we'll depreciate it, right? That, to me, I have a saying that I learned from a friend of mine: don't let the tax tail wag the economic dog.
Man, it's a big problem. We see a lot. You spend $1 to get 30 cents back. And
exactly.
That's not good business.
That's not what we're trying to do here.
But, we're not against you buying that F-350 by no means. But, we want to make sure it makes sense to you. And at the end of the day, it's the taxpayer's money. So, if we can write it off and, substantiate the business use in that asset, then definitely it makes sense from a tax standpoint. But does it make sense in the overall picture is where we like to see the clients thinking, instead of what you just said, letting that tax benefit.
Right. Tax tail wag the economic dog.
Yeah.
All right. Well, that's a good way to end segment one. So listeners, again, one, this is not individualized tax advice, but if you want to have that conversation, give us a call. Sam's organization and my organization are not affiliated, but we do work together a lot as part of a financial planning team. We've got great estate planning. Sam and I both have great estate planning attorneys for referral. Obviously, you hear what he brings to the table for value. If you'd like to have that conversation with us and get to meet the rest of our referral partners, give us a call. That number, Gulf Coast Financial Advisors, that number is 251-327-2124, or find our website, gulfcoastfa.com. Now, the FA stands for financialadvisor.com. And Sam, it's funny, you'll appreciate this. I don't have to tell anybody down here that what the Gulf Coast, how to spell it, right? Mm-hmm. But if I'm talking to anybody north, 9 times out of 10 they'll say, "Is that Golf?" I'm like, "Come on, yeah." Like, no, Gulf. Don't you know where the Gulf Coast is? And also, this is not the ocean; it's the Gulf, by the way.
That's right.
All right. So while you're there on GulfCoastFA.com, there's a blue button in the upper right-hand corner. Click on that. That'll put something on my calendar. It can be as simple as a 15-minute introductory phone call. It can be a 30-minute Zoom, or my preference, let's meet in person. Any of our 3 office locations, that's downtown Fairhope. We're also in Orange Beach. We're just down the road from the wharf. Or in Mobile, we're near the intersection of Dauphin Street and I-65. However you reach out to us, do it. We'd love to meet with you. All right, folks, coming up next, there's a lot going on in the world, particularly the world of finance, investments, and money. Every week we scour the internet for financial articles relevant to those of you in or near retirement. Then we're going to give you our honest opinions about these headlines. So join us after the break to hear Sam and I discuss this week's relevant headlines in our News Headlines of the Week segment. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Welcome back to Coasting in Retirement. Host Josh Knoll here alongside guest co-host Sam Driver, CPA and partner at Johnson, Slaughter, Driver, and Northcutt out of Foley. So as Sam and I discussed before the break, every week we scour the World Wide Web for financial articles that pertain to those of you in or near retirement. Our job, or at least we tell ourselves it is to help you all understand how these headlines impact you, especially when it comes to your money. Now, quick note, if you all want to read our referenced articles for yourself, we do include the article links in our show transcript, which you can find on the website, gulfcoastfa.com. Just go to the podcast tab, find the find the episode that you want to listen to, and then look for the transcript. You'll see the article links there. So all that said, without further ado, let's get it with headlines of the week. So Sam, I'm going to read, Michelle normally reads the headlines and I react. So I'm going to read the headlines. I'm going to set them up for you, and then I want to get your opinion on some of this, okay?
Okay.
I will give you a little quick heads up. Both the first two articles are related to the big, beautiful bill,
Okay.
Right? The continuation or the enhancement of the Trump tax cuts from 2017. So let's start with this. On July 4th of this year, the big, beautiful bill was signed into law. This bill affects a wide variety of things throughout the economy, throughout the United States, throughout the world. But with you being here, I specifically wanted to discuss some of the most important changes to our tax code. The first article I found it on npr.org, not a site I normally reference, but it had probably the most easy to understand information for what I was looking for. The article is titled, "Here are 6 beautiful bill tax changes that will benefit wealthy Americans." Now, according to this article, in America, you're wealthy if you're an individual making over $200,000, or you're a married couple filing jointly making over $250,000. So, to be fair, that affects quite a few people,
Sure.
right? So the article details changes with this big, beautiful bill, such as lower tax brackets, bonus depreciation, which we talked about in the first segment, and then a higher estate tax exemption. Some people would know that as the death tax. It also mentions a higher exclusion on capital gains from the sale of a qualified small business stock issued after July 4th, 2025. Again, here we go with that timing. So my question to you is, all that said, what changes have you already dealt with in your practice related to this bill? And is there anything that sticks out as immediately impactful to what you got going on with your clients?
Yeah, definitely. I mean, one of the main factors we're dealing with, because our client base is a lot of business-related, individuals, is the depreciation is huge. A lot of those other items you had talked about are, they happen kind of individually, maybe one time a year or whatever. You don't see a large pressure of, especially that small business tax.
Yeah, that
deal.
it's a $75 million business, I believe, was the requirement, minimum.
So there's all kinds of criteria there that you want to meet, but it's pretty cool. It's a pretty good deal. You can sell this business for a huge profit and basically defer a lot of the taxes in it.
Right.
And I'm trying to obviously simplifying that a whole lot.
Right.
But those are some of the things that you may not see, in our line of work, on a reoccurring basis that we would deal with, from a standpoint of just the day-to-day operations of the business. A lot of those things that the big beautiful bill, kind of dealing with at this point. especially in the retirement sector. The clients that are a little bit older and collecting Social Security, there's a little deduction there. There was a lot of news articles hit about the non-deduct, having Social Security not be taxable anymore.
Right.
So they weren't able to accomplish that, but they did give a little bit of a deduction on the back end. The administration was able to kind of piggyback that, not allowing that to do. It just wasn't. They weren't capable of doing that from a tax law change.
Right.
So they basically gave the individuals, and there's criteria you got to meet. Of course, there's income levels that you got to meet, but you get a little extra $6,000 deduction on your return for 25 as a single file or joint filer, obviously. And if you're collecting, you get a $12,000 deduction there. So it's not the same as not Social Security not being taxable,
right?
But it was one of those things that got thrown in there. It's like, all right, you're not going to allow this, but we'll do this instead. So so it's not marketed like that, but it is there for these individuals.
Very good. So the depreciation is really the thing that's kind of been across the board with a lot of your business owners.
Yeah, because there's huge deductions there.
Right.
We're buying equipment anyway, and what type of benefit do we get there, and that's what we're dealing with.
I
at
like
the moment.
it.
So
I also, it made me chuckle when they say that we've made the estate tax exemption permanent.
Yeah.
I get a chuckle out of like, okay, we'll see how permanent any of this stuff is.
The big thing there is that it was supposed to sunset
right
in the end of the year and I believe back to $1 million. And I'm not.
I don't know if it was going to go to $1 million, but it was going to go to pre-2017 rates, whatever those were. It was going to be a significant drop.
Yeah, it's a big time drop. And now, again, I don't know the exact numbers here. It's
you're pushing
32 million or something.
You're close to, you're 30 million plus to for a married couple. You're up there. But as you very well know, a lot of Baldwin County business owners, like family generational business and landowners.
That's right.
Yeah, so you'd be surprised how quick that gets pushed through.
Yeah,
so
sure.
It does impact more than you think.
So it was something that we were keeping an eye on for sure, and hopefully that something was going to happen. Because back to those pre-17 numbers, you could get there pretty quick, especially in today's world.
Right. Yeah, no doubt, with appreciation of assets. All right, article number 2. Again, we're going to stay on this big, beautiful bill train for a little bit longer. Kiplinger had a recent article titled "New Opportunity Zone Rules Triple Tax Benefits for Rural Investments. Here's your 2027 strategy." So here's what the article states, Sam. It says, for high net worth investors, the recent IRS guidance released on September 30th this year regarding opportunity zones may be one of the most important dates that they didn't know about. I'm going to be honest with you, I find this topic fascinating because basically opportunity zones are special geographic areas designated by the federal government where investors can receive significant tax benefits for investing in real estate or businesses located in these zones. It was created under 2017 Tax Cut and Jobs Act, which we've referenced a handful of times now. And the idea was to encourage long-term economic development in underserved communities. Now, investing in zones does not eliminate taxes. It just allows investors to defer, reduce, or potentially eliminate capital gains taxes when the rules are followed. So my question to you, Sam, is, have you dealt with that? Baldwin County has exponential growth, but I would say there's probably still some rural areas does it fall in an umbrella? Or are we looking in different areas? Have you dealt with this very much?
No, there's areas in Baldwin County
Amazing.
that you wouldn't think of that are probably right next door to you that may be qualified for that opportunity zone. I'm not talking about the rural area, but because that's new. That's new.
This is a relatively new tax shelter.
So
right? Relative in the whole scheme of things.
Sure. Right. So the opportunity zone's been there, and again, there was areas in the area we're in now that this qualifies, and it may have been in an area that had some decent amount of business related items there. So yeah, it's an area. It's a place to park some money that maybe you have sold some appreciated assets and had some gain there, that you could have parked the money in there and piggyback some of those deductions or deferring that tax basically. And now that they've opened the door up under this rural area, which is new, and the guidance that came out was the biggest thing, because a lot of the times these tax laws come out and you're like, what does this mean?
Right. There's not a real solid interpretation.
So we're looking for that guidance from the IRS or other areas to kind of give us some rules to play by, more or less. And so you kind of brought this to my attention, earlier today.
Well, and to be fair, an advisor brought it to mine. So we're moving down the chain
And
here.
I think the biggest thing people were waiting on is like what does this mean and what areas qualify? And they came up with an area. They have a map or something you can go to kind of see where these areas kind of play into and maybe make sense for you investing in.
Well, what it says here, it says you cannot directly or invest directly in the zone. You invest in a qualified opportunity fund, a QOF, because we have to do an acronym for everything in our line of work. And that QOF has to invest in real estate or rehab in the zone or an operating business in the zone. Here's some examples: multifamily apartment redevelopment, mixed-use development projects, warehouses and industrial buildings, restaurants, retail, local business startups. Although I've always held that the quickest way, if a millionaire wants to become a 100,000-aire, he just needs to open a restaurant. I've always said that. But anyway, back to this point. So those are things where you can invest in this QOF, and it looks like, tell me if I'm wrong here, Sam, but you get a tax deferral, right? So you can take a gain from some other opportunity, invest in this QOF. You get tax deferral. This says that do you get elimination tax on new gain? So some people would recognize as a Roth IRA, you get no additional tax on gain, but it says on this QOF, the answer is yes after 10 years.
After 10 years.
So this is a long-term strategy.
Definitely long-term. And there's tax deferral for the initial. There's a 5-year marker where you get a 10% under just the OC side of things. You get a 10% bump in your basis,
Yep.
a 10% of the gain. So if you sold for instance, if you sold a piece of property at 100, or you sold some appreciating assets for a $100,000 gain, it's kind of low to kind of go this strategy, but we'll use that. And maybe you waited 5 years. Now you get 10% of that gain added to your basis, which is going to reduce that taxable gain. So you'll get a $10,000 bump in your basis. If you hold it for 7 years, I think there's another additional 5, and then the 10-year window is where like you walk away. There's no
additional tax on that gain that you had.
That's right.
So if that $100,000 through your investment turned into $200,000, you owe no additional taxes on an additional $100,000
That's
gain,
correct.
right?
And
Yeah,
there's
that's pretty
other
cool.
things you got to meet in there. You got to do some improvements.
Yeah, this
to
is
it.
not for everybody.
Yeah, no.
Right.
There's other criteria to that, but so and a lot of those funds that you were kind of referring to kind of take care of that. Now you can operate a fund individually as well.
Sure. Okay.
So you don't have to go to these markets that have, I got a OC fund here you can invest in. Again, there's a lot of work into it. There's a lot of things you got to report on every year. There's some compliance you got to deal with.
Yeah.
But you definitely, if you can do your homework and handle this, then there's definitely an area here that you can defer some of this gain.
So for those of y'all that have a large gain, let's have a conversation and see if this is an appropriate strategy for you. All right, article number 3, Sam. Again, I went NPR on one of them. Now I'm going to Staples of all places. But I found it. I was searching for tax planning mistakes that business owners make, and most of the lists I found were just dull. There's stuff you would already know. But Staples had an article, a recent article to boot, called The 7 Biggest Tax Mistakes That Small Business Owners Make. Now, of course, we've covered some of these mistakes, like choosing the wrong corporate entity or thinking that corporate entity is going to do some kind of tax magic for you when it's not, especially depending on your level of revenue. But this article brought up some interesting mistakes, such as not classifying workers correctly. Mm-hmm. I'm assuming it's talking about W-2 and 1099. Maybe you can
That's
say
right.
it right. Underreporting income. And then we talked a little bit about this in the beginning, but my favorite, taking unlawful deductions. Where I was jokingly in the first segment talking about tax avoidance.
Right. Mm-hmm.
We don't do tax avoidance, right?
No.
That's a great way to get an orange suit. But what are some common mistakes that you see in your practice around mistakes that business owners make?
Yeah, we'll just piggyback off that list. And, the employee versus contractor relationship is a big area. The contractor side of things is just an easier aspect of having somebody work for you. You don't have the compliance of payroll. But there's like a 19-point checklist the IRS puts out and kind of dictates whether that person is an employee or a contractor. And, if you don't meet, if you check one of those boxes, then they'll classify them as an employee.
Right.
And we won't get into that list, but I mean, it could be, you telling them where to go, you providing the tools, you doing all this, then they technically would be an employee. Now, what does that mean to the business owner? Well, what that means is you got some cost involved in having that employee versus just issuing a 1099. So a lot of times, there's about a, and don't quote me on this by no means, but usually to pay somebody $1, it's going to cost you 10 cents as an employee
right.
or an employer to do that. So, and then the compliance factor, and again, that's where you look for professionals to kind of help you. You can unload that payroll module from yourself and having to deal with that by just having the right people in place, and maybe that's an area that you can not have to deal with. So you definitely want to look at that. Obviously there's deductions there that people deduct that shouldn't be. That's obviously
the gas going into a Porsche box.
Yeah, that's
to drive to the beach.
That's a well scrutinized area, and we see that a lot.
Well, with the hundreds, probably thousands of business owners you've dealt with, what is going to be appropriate and accepted and what's not.
That's right. We have industry standards we kind of look at, and there's criteria we got to meet, and just having somebody kind of review that, and that's where we come into play. There may be things that you're not deducting that you're not thinking about. Those areas
You've
too.
helped me with that, absolutely.
So,
yes.
It's not just the person that's deducting everything from the veterinary bills to whatever.
Right.
There are items out there that you may not be thinking about that maybe would be deductible versus all these other things you're coming up with. So just having the right people in place to kind of help you with that. And again, back to our original conversation, it's just planning.
That's it.
Just having the right folks in place and doing the right planning. And you can't spend your way out of taxes, but you can definitely put yourself in a better position.
Very good. All right. So last article for the day. So Sam, I've been throwing some different stuff at you. I wanted to close out with kind of an easy one for you to knock out of the park. Plus, I wanted to help listeners find your website. So your firm, Johnson Slaughter Driver in Northcutt, they have a recent news article on their website titled 5 Smart Tips for Individual Year-End Tax Planning. So I pulled it up. I read it. Can you explain to the listeners what, quote, using bunching to maximize deductions is? Can you explain how someone would balance gains and losses? And then lastly, can you fill in listeners? I did know this, but I haven't done it in a long time, but how listeners can potentially use their qualified accounts to make year-end charitable donations. So let's talk about what is bunching to maximize deductions.
Yeah, I guess I probably should have read that article before I put it out.
I thought you wrote it.
I think it's probably recognizing, maybe you look at your portfolio and determine what's going on there, and maybe you had some appreciation on some stocks that you might have sold. So, and maybe we have some low performance stocks. Maybe we bunch those to kind of offset some of those gains that came through. So
no, you're on the right track. What it means is timing certain payments like your mortgage interest, your taxes, so that you push yourself above the standard deduction for the year. So you were on the right track, yeah. But bunching to maximize your deduction, that's funny.
Yeah, that's something we play with a lot during this tax planning world. Ideas. The standard deduction versus itemized has gotten there's a big gap there. So your standard deduction now is pushing $27,000, I believe, or somewhere in that nature. So, and a lot of things that get you over that window would be mortgage interest and charitable contributions, obviously, and then state taxes are another area that's changed under the new bill. Where that was capped at, your real estate, your income tax that you pay at state level, it was capped at $10,000. Now it's $40,000. So that was a big. We didn't talk about that earlier, but that is a big area that's going to be taken advantage of. So yeah, a bunch of those. Now I know what you're talking about. We do that. That's tax planning.
There you go.
There may be a time where you try to double up that charitable contribution rather than wait until January to push it through. So, so definitely something you can maneuver around. But it's just really understanding where you're at and where that standard deduction is, and where you fall on those itemized items as well.
Right. And then this is obviously a very specific situation, but for those of you all listening that are 70 and a half or older, you can make charitable donations from an IRA. It's called a qualified charitable distribution. And again, we have to give an acronym for everything. It's called a QCD, right? So let's say what it tells me here is on your newsletter, it says you can donate up to $108,000 in 2025 directly to qualified charities, keeping those amounts out of your taxable income.
That's right.
So that's going to reduce your adjusted gross income and all those things, right?
Yeah, that's definitely on there. And I have a lot of clients that take advantage of that. Say, for instance, we got somebody in that realm that has to take that RMD and they don't need it. They don't need. It's hard to say you don't need the cash, but they don't want to take it out of that RMD, that required minimum distribution from that IRA.
Right.
So and they give money away anyway. So maybe that RMD comes in at $50,000. They don't need it in their bank account, which is a great problem to have, and they're going to give away $50,000 anyway. So what they do is utilize that vehicle there to route that RMD to these charitable organizations.
Right.
They don't take possession of it. It goes directly.
Right.
It has to happen the right way. And what that does is it keeps $50,000 in our scenario off their taxable income, which can affect other things that they have going on. taxable Social Security benefits, that kind of stuff, and also allows them to take that deduction as well. So it's a big vehicle there if you know about it and have if you have these accounts set up. And I believe, there's nothing real special about them. You just have to know what's going on and be able to plan on that prior to either taking that RMD or having that advisor know exactly what you want to do with that
Very
number.
good. All right. Well, listeners, if you've liked what you've heard and you want to continue the conversation, we invite you to reach out to us. Give us a call, 251-327-2124, or visit our website, gulfcoastfa.com. Again, in the upper right-hand corner, there's a blue button that will put a meeting on my calendar. We could just do a 15-minute phone call. We can do a 30-minute Zoom, or my preference, let's meet in person. Any of our 3 office locations, downtown Fairhope, Orange Beach, or Mobile. However you reach out to us, make sure you do it. All right, folks, coming up next, quickly, we got our last segment, Joshua's Crystal Ball and Big Mouth. We'll spend some of my predictions. Was I right? Was I ever wrong? Now, Sam, just for the record, because you haven't been on the show before, but I'm usually right, just so you know.
Yeah, I understand.
I'm a skeptical about guy, and I'm from Missouri, the show me state. But you and I didn't get a chance to prep on this part, so I'm going to ask you, nothing bad. Are CPAs, do they tend to be cautious by nature, or is that just a stereotype?
I think it's historically, yeah, probably.
Okay.
There are some, I guess we can say we're aggressive in a sense too.
Yep.
We don't work for the IRS, work for the client, but we also follow the rules. So
Right.
there's a lot of gray area in what we do.
Well, as our mutual friend Trish would tell you, the financial advisory industry tends to be full of a bunch of prima donnas and drama queens for sure. So I appreciate my CPA friends. Well, let's see if we can get a bold prediction out of you, Mr. CPA, in our next segment. Coming up, stay tuned. Whether it's building a business from scratch with your own 2 hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF, like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back. Your host, Josh Knoll here. Got special guest co-host, Sam Driver, CPA. So regular listeners know, and Sam, you've gotten to know me a little bit. I'm opinionated. I've got a motor mouth. I know this. I've got strong opinions. I would say a radio show host that isn't at least somewhat opinionated would be very boring to listen to. Just replace me with AI, which may happen anyway. But I wanted to. This segment's pretty fun. Usually, this is the part of the show where Michelle tease up something I've said in the past that didn't play out, or something I said that proved to be kind of dumb, which is pretty easy pickings for her. So what I wanted to ask you, we talk a lot about this show, about monetary supply and budget deficits. It kind of forms some of the basis of our investment management thesis, in that as long as the federal government runs deficits, they have to finance those deficits. They do that through the issuance of debt, which automatically increases the monetary supply. Mm-hmm. Money is like water. It wants to flow somewhere. A lot of times it's going to flow into equities in the stock market. It doesn't mean the stock market is always going to go up. It just means that when you continually print new debt and print new money, you're automatically devaluing the dollar, which means that risk assets such as stocks are going to benefit at some point from that.
Sure.
So my question to you is, do you think we have, oh, this is loaded. Have you ever had anybody say, Sam, I pay just way too little in taxes. I need you to come in and correct this. I need to pay more.
Yeah.
I'm not paying my fair share of taxes, Sam.
That's right.
Have you ever had anybody say that?
Actually, I haven't.
Oh, my God.
I don't know that I ever will. But, so just to be on, you can actually write the check.
You can write for more.
Check. You can pay
and
more
they will
than your
cash
own.
it.
Yeah, they will.
Yes.
So, but I've never had anybody do that. So.
Yeah. Do you ever see, what is the likelihood of somebody coming in. I want to be careful here because I was as a kid when Jimmy Carter was president. You weren't even born yet. And so all I remember as a kid was my dad coming back and being really happy about getting a 13% interest rate on a construction loan.
Wow.
So that tells you what kind of rough area at time it was.
Yeah, sure.
But they were doing those high interest rates to kind of mop up money, and they raised taxes. Do we see any of that happening anytime soon? What's your prediction around that?
Yeah, so my prediction at this point, it's administratively, kind of tailored to the administration, and right now you won't see that.
Right.
I don't think you will. Now that doesn't mean you won't in a couple years or whatever, but there's a lot of factors that go into that. But no, I mean, in order to invest in the company or yourself, you have to have that cash on hand in order to do it. So,
because you can look at the history of investment in corporations, and you can look at the mid 70s where the highest marginal tax rate was 90%.
Yeah, it's crazy.
And you had so much little investment, and you had so much shenanigans to avoid it. It was self-destructive, right?
Sure.
Right. So, yeah, I'll be curious to see how that goes. Right. It's funny how little the deficit gets talked about anymore. So we'll be curious to see. Sam says no. I got to be honest. I don't see it happening anytime soon. Deficits in and of themselves aren't necessarily a bad thing. It becomes a bad thing when the interest carry on the deficit starts becoming a large percentage of the overall federal budget, which is a problem we're running into. But all right, very good. Well, listeners, I hope you enjoyed a little peek into how we form our opinions and make predictions. We're going to invite you one last time. If you'd like to have a no pressure, no obligation conversation about your investing goals and retirement dreams, give us a call, 251-327-2124, or find us on the website, gulfcoastfa.com. One more time on the site, there's a blue button, click it, put something on my calendar. 3 locations, downtown Fairhope, Orange Beach, off Canal Road, or Mobile near the intersection of Dolphin Street and I-65. If you want to follow up with Sam Driver, he is out in Foley. Sam, what's the best number for folks to call?
You can call the office, 251-943-1565, and we have some ladies there that'll help you kind of get something scheduled. Yes,
and I would tell everybody your website, but it's a tough one. It's JSDNCPA.com. You're better off just Googling Johnson, Slaughter, Northcutt, and Driver, and you'll get to their website.
You'll find us.
But yeah, folks, I highly encourage you, if you are interested in CPA and accounting services, if you're interested in tax planning, why don't you reach out to Sam. His team does a great job. They work with a lot of our clients, and our clients are very happy with their services. So thank you. I do want to thank you for being a guest co-host, man. What do you think?
Yeah, it's great. It's first time, so it was pretty cool. So
it won't be the last time. You did. I mean, this is one of the ones that's going to get listened to a lot because everybody wants to know about taxes.
No, definitely.
Yeah, they can get a little bored with mutual funds and things like that, but they do want to hear about taxes. All right, I want to thank our show sponsor. That's Mr. Jay Stubbs and his company, Providence Partners. Thank you to our awesome radio station, that is FM Talk 106.5 out of Mobile. Many thanks to the provider of our show music, that is local band Sloth Racer. Huge thank you to the show producer, that is my son, Peyton Knoll, War Eagle, just like your daughter, right? He's sophomore, she's a junior. And as always, my sincere appreciation for all of you out there that have been joining and listening with us on this journey. We would love to be a part of your journey as well. Till we talk again, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting in Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and or prospective client as GCFA's solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice or compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.